Are you thinking about buying your first home, but you're not quite ready? Well, there's a lot of things that you could be doing in order to prepare yourself, whether you're 6 months or even a year out from buying your first home. I wanted to give you some tips and advice to get you in the right position so that way when you are ready to purchase, it should be smooth sailing. As a mortgage lender, we look at 4 key factors when getting someone qualified to purchase a home. The acronyms that we use is CCID. So cash, credit, income, and debt. That's how I learned the mortgage business when I first got in 15 years ago. The guy that I worked for at the time told me to remember that and never forget it. So I'll break down how it all plays a part of each other and helping you get into your home. And I think if you stick to those 4 key factors, it's going to get you into the right position to buy your first property. So like I mentioned, the first part is cash or your down payment. So the cash that you have on you, you want to make sure you start saving up money. There's a lot of people that talk about budgeting and getting yourself comfortable to be able to purchase a home. And I think that's a great way to start learning what it's going to cost for you to become a homeowner. For example, let's say your rent is $1,500, but you're comfortable maybe paying up to $1,800 or even $2,000 a month for your mortgage payment. I would start paying the new mortgage payment back to yourself. So maybe you pay $1,500 to your landlord, and maybe you're dropping another $500 into a separate account. So that way you have the same expenditures every single month as if you are already a homeowner. I think mentally and psychologically, when we look at our bank account and you're seeing that $2,000 is going out every single month, it's a different feeling to know that that money's not there, and you should be saving that in the same token so that way you can build up extra reserves when it comes time to buy your house. Now, buying your first property does become a little overwhelming. I remember when I first bought my property and my name was on all the utility bills. Back in the day, I lived with 4 guys. So one guy had the gas bill, one guy had the electric bill, one guy had the trash bill, and one guy had the sewer. So you only seen the bill that you were paying for and kind of split it amongst the roommates at the time. But once you close on your house and your name's on all of those bills, when I first moved in, I was like, holy smokes, this is starting to become a little overwhelming, because it was like every single week there's more bills that you have to pay, whether it's stuff for the house, the HOA, then your mortgage statement comes in, then you have your credit cards, then your car loan, all of this stuff that just starts piling up. And it literally felt like all I was doing was paying bills, which is kind of funny because when you're a kid, you always hear your parents talking about that oh, you're just paying bills. So it does get a little overwhelming. So I would get yourself into that mindset of that this is your house. This is your payments that you are responsible for. So again, get comfortable paying the extra amount of money that you're going to be paying when you become a homeowner. Again, one of the tips that I like to do for myself, even when it comes to investing, is I set up auto drafts in my account to automatically sweep a certain amount of money every week, every 2 weeks into certain accounts. And honestly, I don't even look at the money. I don't even know what's going out. I just know that I set it up once and that's it. And there's actually a really good book that you can read. It's called The Automatic Millionaire. And that's one of the ways that they talk about investing money, is setting up some of these auto debited programs so that way you auto sweep this money, whether it be to a life insurance policy, whether it be to an index fund or anything like that. There's a lot of ways that you can do that, and literally money just accumulates over time. Next thing you know, you got an extra 10 grand sitting in your bank account that you didn't even think about. That's a really good way to start building up down payment money and building up some reserves that you'll have to buy your house. And another tip, if you work in an industry where you get tip money and you like to keep your cash at home, I would strongly suggest you start depositing those funds into your checking account. And the reason is, when you go to your loan officer, they're going to ask you for the last 2 months of bank statements when it comes to your pre-approval. So if your 2 months of bank statements do not reflect where your funds are coming from, guess what they're going to ask you? Hey, Joe, where's your down payment coming from? And if you don't have an answer for them, you say, hey, Sean, well, my money's in cash, man. It's at my house under my mattress. Guess what I'm going to tell you? Joe, your money needs to be in your account and it has to be there for 2 months. Or you're going to have to get a gift from a family member to buy a house. So to avoid asking any family members to help you to buy your house, start putting the money into your account. Now, we want to avoid large deposits. That's a big no-no when it comes to mortgage lending. Now we're moving on to our second C, which is credit. You want to start to get familiar with your credit score. I like to use Experian.com. You can pay for a premium service. I believe it's only $19 a month, and you can monitor all 3 credit bureaus. I was doing this for a short period of time just to kind of get an idea of what was really happening with my credit. I was trying to get my score as high as I could. I think right now I'm about a 740 or so. Obviously I bought a bunch of houses and stuff last year, so I've got a bunch of inquiries that are on my credit report, but 740 is still pretty good. And I think it's really good for you to understand what your credit score is, whether it be Experian.com. A lot of you like to use Credit Karma, Credit Sesame. Those are good, but just know that those credit scores are probably about 50 or so points higher than what any mortgage lender is going to pull when they look at your credit report. So don't get a false sense of confidence when you look at that, because I've talked to a lot of clients where they're like, I've got an 800 credit score. I even had someone tell me they have a 900 credit score once. And I was like, how do you do that? I've been doing this for 15 years. I've never seen a 900 credit score. And this dude that I was talking to was so confident. Man, I wish I was doing content back then. That would have been a good video to talk about, but you don't have a 900 credit score, okay? So get to know your credit. Try not to open up new debt, right? I know we get excited when you see the Best Buy commercials and you got 0% financing for 72 months and you can go get you a new 85-inch screen TV. Don't do that. Or buying a new car, just stick with what you got, get the house first. And if you have questions on that, I made a whole video about cars and houses, so make sure you go watch that video. That way you are doing the right thing with your credit. Try to get your credit card balances under 30% of whatever the utilization is. For example, let's say you have a credit card and you have a $10,000 limit. You want to get your credit card balance under $3,000. That's the kind of ideal rule of thumb that a lot of credit people will give you advice on, so I will do the same and pass that on to you. Remember, 30% or less. Now we're moving on to I, income. One of the things that we look at as a lender is, have you been on your job for the last 2 years? That's kind of the rule of thumb in mortgage lending. You can switch jobs as long as you're in the same industry, but try not to move around too much. One thing we don't like to see is someone who's changing jobs every 6 months. That there's no stability behind that. You want to try to be at your job as long as possible. If you are moving around, again, this is why we're doing this video, from 6 months to a year out from buying, talk to a loan officer, because the last thing you want to do is move around for the wrong reasons, thinking you're doing the right thing, only to hurt yourself when it comes to buying a house. For example, I had a client, her name was Stacy. Stacy was a veterinarian. She was getting paid from a specific medical agency and they were paying her through a W-2, so she worked for this specific company. She wanted to go out and start her own business. She now went from being a W-2 employee to a 1099 self-employed borrower, which just throws all kinds of problems when it comes to qualifying. So in Stacy's case, she could not buy because she has no history of being self-employed. Again, this is a perfect video for Stacy, because if she's 6 months or a year out from buying, she should have talked to a lender if the thought of buying a house was on the horizon. The lender would have told her, don't quit your job right now, buy the house first, then you can go start your business. Because we don't have a history. In mortgage lending, one of the things that we look at is the history. Right? We're looking at your income, 2-year history. What have you done? What have you earned? And what are you currently making at your job? The entire picture just has to make sense. You can't go making $50,000 one year, $100,000 the next year, and then you're back to making $30,000 again and say, well, hey, I made $100,000 last year. Well, you did, but this year you're on pace to make 30. Your income's down by 70%. What's the reason behind that, right? So you have to look at these scenarios and just look at it from a practicality standpoint. Well, what is the lender going to look for? But again, W-2 and 1099 self-employed borrowers are the two biggest things that we're going to be looking at. You are self-employed, great. Keep doing what you're doing. Make sure to tell your CPA that you do plan to buy a house, because when you're self-employed, we look at your net income. Net income meaning your income after expenses. W-2 borrowers, we look at the gross income. income earned prior to taxes being taken out. So two opposite ends of the spectrum, but that's how we qualify both types of clients when it comes to buying a house. So if you're self-employed, make sure to talk to your accountant, let them know you're thinking of buying a house. If you have a good loan officer, connect your loan officer with the CPA. I've done this numerous times for our clients where we will actually talk to the accountant ahead of time, knowing that Samantha is going to be buying a house. Well, how much income are we truly going to show for her, and how much do we need to qualify her for the mortgage? Because the accountant's job is to limit your tax exposure, which means less and less net income. But as a mortgage lender, that hurts when it comes to qualify you for the mortgage, because I need more net income to give you the amount what you're looking to buy. Now, we do have programs for specifically self-employed borrowers where we can literally use your bank statements to qualify you for a loan. The interest rates are a little higher. So anytime you go outside the box, remember, you can definitely get a deal done, but you might have to pay either a little more down payment or your interest rate could be potentially higher than what the current market rate is. For the sake of this video, let's just keep it to the basics of using a traditional conventional loan for financing, so that way you can purchase your home. Now, again, W-2'd, we're looking at your gross income. Make sure you're stable with your job. If you're bouncing around, try not to do that. And another tip for those of you that actually want to work 2 jobs, what we look at is, have you been working at that second job for 2 years? Again, we like to see stability, and here's why. The thing is this: if you couldn't qualify for a mortgage today, let's just say you ran out and got a job somewhere and you got an offer letter saying, hey, I'm gonna get paid $25 an hour to go work at XYZ Incorporated. Give that to your lender. Your lender's like, oh great, let's qualify you for this mortgage. You might work for 30 days and quit just so you could buy your house. That's why we like to see stability, because of situations like that where one bad apple will spoil it for everybody. We can't just take your word for it that you're gonna go work there. We need to see a history. So don't run out thinking that, hey, I'm gonna take on this second job for 2 months, show my lender, quit. Doesn't work that way. We're gonna wanna see that you've been there for 2 years. And D, we're talking about your debt. This goes along with the credit portion, but as far as your debt goes, try to keep your debt at a minimum. If you can try to pay some stuff off, that's great. Keep your credit card balances under 30%, like I mentioned, but also try not to close out any accounts. Closing out accounts can hurt your credit score. If you're gonna close anything out, wait until you buy your house, then you can do whatever you want with your credit. One of the things you wanna avoid closing is a car loan. That will hurt your score, and credit cards. So maintain a zero balance, even if you paid it off to absolutely nothing. Keep the card open, buy the house. Then if you really want to get rid of the account, go ahead and do it then, because you got the house, you've got what you needed. Now you can go ahead and eliminate the credit card if you so choose that you just absolutely don't need it anymore. I've done that personally. I just hate having a bunch of credit cards laying around in my house because I have zero use for it. So there's been cards in the past that I've closed out, but as long as I know that I'm not making a big purchase where my credit score is going to be predicated on whether or not I get approved, it's obviously your choice, however you decide to handle your credit. But as far as the debt goes, make sure to keep your debt at a minimum, because we do have to factor in the new mortgage payment that you are looking to qualify for to purchase your home. So those are the 4 key pillars that you should be thinking about if you're 6 to 12 months out from buying your home. So remember, cash, credit, income, and debt. Those are the 4 ways to remember how to buy a house. Thanks for watching. I'll see you on the next video.